All right, in this video, I wanted to cover how is income allocated in an S corporation. So I get this question very often when a company is looking to make an S election and they just want to know, okay, how does this change things? So like if I have multiple owners, what do we do now? So we'll cover some of the basics at the top here and the general rules, and then we'll dive into some examples and talk about income allocations and this one class of stock principle that applies to S Corp. So firstly, what is an S Corp? An S Corp is not a type of legal entity. So in other words, you can't go to a state and ask them to form an S Corp for you, right? An S Corp is, firstly, you have to form a domestic eligible entity, and then you make an S election afterwards with the federal government. So you send that to the IRS. So for example, you have to form, let's say, a Delaware corporation, and then you go make an S election afterwards. S elections can be filed for domestic corps. They can be filed for LLCs, PLLCs, which are professional limited liability companies. There's a number of domestic entities that can file this election. So what are the general rules for an S Corp? Well, the first one, again, is it has to be a U.S. entity. So the U.S. entity is important because you can't form, let's say, a Cayman Islands company and make an S election for that entity, even if the entity is owned by U.S. persons. It's got to be a domestic company. Once you have a domestic company, you file that election via Form 2553. The IRS either approves it or rejects it, and they send you a confirmation notice. Now, the other limitation with S Corps is you can only have U.S. shareholders that are natural persons. Now, there are some unique exceptions for U.S. trusts or U.S. estates, but for the most part, this is the standard. The shareholders all have to be individual natural persons, and they have to be U.S. tax residents. So you can't have any entities in there, no partnerships that are shareholders, none of that works. So the U.S. persons are either U.S. citizens, U.S. green card holders, or they're U.S. residents that meet the substantial presence test. So that would be somebody that, let's say, they're in the U.S. on an H-1B visa, so they live and work in the U.S. on a full-time basis, and they're a U.S. tax resident, but they're not a green card holder or a citizen. They would meet the definition of a U.S. resident. So also the entity can only have 100 or fewer shareholders. Okay, so you can't have 500 different partners or shareholders in an S Corp. That's not permitted. And then lastly, the entity must only have one class of stock. And it's this one class of stock rule that we want to kind of focus on for this video. So one class of stock means that income, expenses, credits, distributions, all of that must be allocated in accordance with this one class of stock principle, which means that everything is apportioned to each shareholder given the amount of ownership percentage they have in the company. So everything is proportionate to the amount of stock you own in the S Corp, period. You can't allocate things differently by item on a per person basis. Okay, so let's look at an example here. We have John, Mark, and Sandy, and then Sarah. So 4 people form a Delaware Corp. Each person owns 25% of the stock. So they each own 1/4 of the company. Now, under the Articles of Organization that was filed with Delaware, the corporation is authorized to issue 1,000 shares of Class A common, and it is not authorized to issue any other types of shares, right? So no common, Class A Class B, Class C, Class D common, no preferred shares, none of that. It's just straight Class A common stock, period. Now, the corporation issues 250 shares to each shareholder, and then the corporation subsequently files this S election with the IRS. So now at the end of the year, the corporation has net profits of $100,000, and it has $24,000 in cash that it wants to distribute to the shareholders. On the K1 for each person, line 1, ordinary income allocation of this 100 must be $25,000 per person. It's got to be 25% per person because that's how much stock each person owns. And then in addition to that, line 16D, which shows the amount of cash that's distributed to each person, has to be 25% of the total. So if you had 25% of 24 grand, $6K to each person. That has to be the way you allocate all of these income items and distributions, right? No special allocations are allowed. So for example, if the company had $24,000 in cash to distribute and they wanted to give let's say $10,000 to Sarah, that would not be allowed because Sarah would be getting $10,000, which exceeds her allocation of 25%. So if a company does that, what they've done is they have inadvertently terminated their S election. They have distributed cash to an owner in excess of their allocable percentage, and that effectively creates a second class of stock, which is not allowed. Okay, so let's look at a multiple classes of stock example, which would prohibit a company from even making an S election. Okay, so in this example, we have the same people, John, Mark, Sandy, and Sarah. They form a Delaware Corp. They each own 25% of the Class A common. But what's different here is under the Articles of Incorporation, the company is authorized to issue the 1,000 shares of Class A, but it's also authorized to issue 500 shares of Class B. Now, the corporation issues the same 250 of Class A to each person, so they each got 25%, and then it issues 100% of the 500 shares of Class B to Sarah only. So John, Mark, and Sandy get no Class B stock. Now, why would the company do this? Well, the company issued 100% of the Class B units to Sarah because the company is going to invest in a side project, and Sarah is the only one that wanted to participate in the venture. So she's going to put up all the capital, and for that reason, she's going to partake in all of the profits, losses, proceeds, distributions, whatever it might be from this venture. And so for that reason, she's the only one that holds Class B stock. This is perfectly allowed for C Corps, and it's also 100% allowed for partnerships. So if you have, let's say, an LLC that's taxed as a partnership, files a Form 1065, partnerships can specially allocate income or loss per partner depending upon the arrangement. You see this very frequently in private equity funds, hedge funds, venture capital funds. They have these types of arrangements where only certain partners in a company will put up the capital to invest in certain ventures, and so for those reasons they need special allocations. This is okay for C Corps, this is okay for partnerships, but this is not allowed in an S Corp context, right? Because you can only have one class of stock. So in this hypothetical here, the company wouldn't even be allowed to file an S election because under their articles, they're allowed to have two classes of stock, and they really even shouldn't get going in that front, right? So you only want to have one class of stock if you're going to make an S election to make sure that you don't inadvertently terminate your S election by doing something stupid. So that covers it for this slide on how income and other items are allocated. I hope you found that helpful. I appreciate you sticking through to the end. I know there's a lot of material. If you have any questions, please leave me a comment below. Happy to answer those. And like always, I look forward to seeing you again soon. Thank you.